Lesson 1, Investments Overview. So I have a disclaimer. This is Investing 101. So it is designed for investing basics for those who don't really know that much about the market and want to learn what it is all about. So if you want to skip to the Husky games, then you can do that by jumping to the 20-minute mark or thereabouts. All right, 3 main stock tracking indexes. So we have the S&P 500, the Dow Jones, also known as the DJIA, and the NASDAQ. And what do they mean? How do they relate to buying stocks or bonds? And for that matter, what is a stock? What is a bond? So we'll dive into those basics. First, we'll look at a common term that you'll hear in the industry, and it is called a ticker. So what is a ticker? So it is a short form to name a company or index. So I listed a couple examples. NVIDIA is NVDA and Amazon is AMZN. So you'll often hear financial news use the term ticker. That should shed some light on what they mean. So in the olden days, that I'm calling anyway, roughly from the 1870s to the 1970s, they used ticker tape machines. And this is what those machines look like. So they would physically type the letters, kind of like a typewriter basically, and the current price would be printed out, and it's all being transmitted by Morse code across telegraph wires throughout the country. So this is the basic information that people would use to buy or sell orders to purchase or dump shares of stock. So this is what tickers look like today. So as you can see, everything's digital. So we still use the short form of generally 3 or 4 letter designations to each company, like we shown up above, the NVDA and AMZN. And it'll show its current price, as you can see in the graphics, and it goes up and down in a matter of milliseconds during the open market. So what you see is the process of people buying and selling. So the more shares that are purchased, generally the prices will go up. And then the more shares that are sold, obviously the opposite, the prices go down. And throughout the day, you can see the prices will move based on sometimes good or bad news. Other times the price might move without any real particular reason at all, and it's simply due to the whims of people. So now we'll cover what the S&P 500 is. So it's also known as the Standard & Poor's 500. And it tracks 500 companies. Obviously, that's in the 500 name. It reflects the U.S. economy. Examples, as I showed in the graphics, of company logos: NVIDIA, Apple, Microsoft, and Amazon. The Dow Jones, or DJIA, as I just mentioned, will be also called the Dow Jones Industrial Average. And that tracks 30 companies, so a lot less than the S&P 500. It reflects more established large companies in the United States. Examples are Goldman Sachs, Caterpillar, Microsoft, and American Express. The NASDAQ. So it's also known as the NASDAQ Composite. It tracks greater than 5,000 companies, so 10 times more than the S&P 500 and much, much more than the Dow Jones. So it generally tracks technology companies. Not all are technology, but most are. And examples are NVIDIA, Apple, Microsoft, and Amazon. So note that the S&P 500 actually had the same companies shown here. And oftentimes you will see the same companies across the different indexes. So Microsoft we actually saw in the S&P 500, Dow Jones, and NASDAQ. So what is a stock? So a little lengthy explanation. So public companies issue shares mainly for one reason: to raise money. And the reason they want to raise money is they might want to reinvest in their company with buying more equipment, maybe hiring more employees, expanding the company. Um, so when they issue shares over time, investors will make trades, buy or sell to other investors. Those who buy shares hope that the price will go up, and those who sell shares generally think the price will go down. Or sometimes they sell because they want to rebalance their portfolio because they're maybe a little heavy on this one stock, and it helps raise money to buy something else. In this case, or all these different cases, actually, neither the buyer or seller really necessarily right or wrong. Various factors can affect the price, and sometimes it experiences volatility. So that means many ups and downs in the price over time. And you can see that in these graphics that usually anything that's within the year, you'll see a lot more volatility where there's up and down for prices being adjusted. Someone sells more shares than they purchase, and then sometimes a large group buys more than others will sell, then prices will reflect that. And volatility isn't bad. Um, in fact, we need it to demand a better return on our stock investment. So, what is a bond? So, governments, usually federal, states, and municipal, meaning cities, will need to raise money. And they do that by issuing bonds, which is a form of a loan. And some companies will also do the same thing rather than issuing shares. They'll have bonds also that they want to have some money raised and that they'll pay a modest interest rate. So when you issue a bond on the open market, investors will sometimes purchase these bonds for a fixed rate so that it is more predictable. So it'll be more of a straight line that will go up. So unlike stocks, bonds usually are non-volatile, and because they lack the ups and downs of a stock, they will pay a modest rate. So investors, especially those who are near or in retirement, they'll need some predictability on their money since they will need it in the near future to pay for living expenses. And sometimes those living expenses will need to be covered for 3 years, 5 years, 10 years for some retirees so that they have some sort of predictability in the future in case there's a market crash. And this is what the bond certificates will look like, at least the government ones. And other ways to buy bonds will be in an index, and I'll cover that coming up. So how to begin. So there's multiple ways to buy shares of stock, bonds, and indexes. And I wanted to point out that indexes can come in different forms like an index fund, mutual funds, and ETFs. And they're very closely related to each other. And I'm just going to keep it simple for the remaining of this lesson that I'll just generally use the term index fund, and that actually means these other forms as well. So ways that we can invest, the most common way is from our job. So many of us will have access to a retirement account through our employer, but not all jobs offer the same type of retirement plan, and sometimes none at all. So it really depends if your company is a larger company or a small company. And if we do work for the government or military, that will also use a different type of retirement account. And if you work for a nonprofit, you'll also have access to a different type of retirement account. So we'll take a look at a few of these. So the 401k. So 401k is the most common retirement plan for the private sector. And most 401ks have, say, 10 to 15 funds available, say about a dozen for us to choose from. But there'll usually be one in there that will reflect the S&P 500. And usually there is a match up to 5%. Sometimes it might be less, but meaning that if we put in 5%, then the company will match the 5%. So in essence, we are saving 10% of our income to invest for our retirement. So it's definitely a nice advantage to invest in a 401k just to get the match. The TSP. So that means Thrift Savings Plan, and this is for government and military employees. So fees are kept low and investment options are simplified. So as an example, a C fund means common stock index, which reflects the S&P 500. So currently the TSP matches up to 3% and the next 2% at 50 cents on the dollar. So you put in 5% and you get a 4% match or a total of 9% for your contributions. So like a 401k, it's also a really good way to save for retirement. The 457B. So it's very similar to the 401k. The difference being that 457B is mostly used by nonprofit organizations. One advantage is that employees can make withdrawals without penalty before retirement age. However, not all plans are perfect. One type of a complaint that I've read about nonprofit plans or 457Bs most commonly carry much higher fees than a 401k. And this is a common complaint. So you can still save for retirement if you happen to have access only to 457B through your employer. But just realize that it may not be as advantageous, say, as a 401k and TSP. So a pension plan, and I put a question mark. And the reason is because pension plans are really an anomaly at this point during the time that we live, but they were something that could be relied upon in the past as fixed income in our retirement without having to participate in another type of retirement plan. But they began to phase out around the 1980s after the creation of the 401k. So if an employer does not offer a pension, good news is that employees can have a little more control with a 401k or some other type of retirement plan. But the bad news is if you don't participate in saving for retirement, those who do not participate generally cannot retire when they want to. And then you're just left holding an empty bag. But there are other ways to invest. So we'll move into on our own. So if you don't participate for whatever reason in your employer plan, but if you do have a plan in your employer, I definitely would suggest at least getting the match if they offer a match. But let's say the fees are really high, then this would be one other option to look into. So if they don't offer a retirement plan, or if they do, but you want to also have a little more options, then you can choose to invest outside of your employer. Then there are other types of accounts you can open to do just that. And within those accounts, we can find that we'll have many choices in stocks, indexes, bonds, and other special types of investing like REITs, which stands for real estate. There's commodities, generally reflects gold. You have foreign exchange and also cryptocurrency, just to name some of them. In fact, you have access to multiple accounts in your name if you want to, as well as keeping one in your employer's plan. So they're not mutually exclusive. So that gives us a lot more control over our destiny. So we'll look at some of those options. So account types. So the simplest way we can open up an investment account on our own is the individual cash account. We can buy, sell stocks at will, but we'll have to pay taxes on realized gains. So the next type of account is the IRA. And it's similar to our 401k, but with much more investment options open to our deep desires. So we can buy, as mentioned in the previous slide, company stock, indexes, REITs, commodities, and cryptocurrency indexes. And any gains that we realize will not be taxable until a later date. The exception is with the Roth option, but I'll discuss that in the next slide. As an aside, we can also open up education accounts. So they're commonly known as 529 plans. And so it's parents or relatives, friends in many cases can contribute and be invested in different index funds for a child to help pay for college. So 529 plans are similar to each other, but the index funds vary based on the state that the 529 is offered. So usually a parent will open a 529 plan in the state that they live, as they generally can take a tax deduction for those contributions. So then we'll get into account versions. So previously we discussed the 401k and IRA as versions of retirement accounts. And just to remind once again, a 401k is offered by the employer, or in other cases, the TSP, and the 457, or I'm sorry, the 457 B. And but we can also open up an IRA by ourselves. So we can decide with those, either 401k, IRA, what version we can use. So the traditional is a pre-taxed, money is used from our paycheck, so it's not taxed, but will be taxed later when we withdraw from it. A Roth version is after-tax money used from our pay that's already taxed and will not get taxed later when taking withdrawals. So there's advantages to using one or the other or both. So because we can use pre-tax money on traditional accounts, we have more available to invest into that account. Obviously, we have more if we're taxed nothing on that amount. But with a Roth, though we'll be able to invest less because it'll be with money that's been taxed, it's valuable for the future because it can grow tax-free, and then when we withdraw, no taxes on it. So one other aside I wanted to point out is we can have all versions of these accounts at the same time. And I think I discussed they're not mutually exclusive. So we can have a traditional 401k, we can have a Roth 401k in most cases. Not all companies offer that. But then on our own, we can have a traditional IRA and a Roth IRA. So depending on people's circumstances, it can be quite useful to have, say, a combination of a traditional 401k with the employer and get the match. And then if you have further money to contribute, then you would add that to the Roth IRA, so that your traditional can be withdrawn first at retirement. You'll get taxed on it. But then during that time, the Roth IRA continues to grow tax free. So I'll discuss more saving and withdrawal strategies in the future, in forthcoming lessons. So a Husky summary. So number one, so there's three stock tracking indexes are commonly known as the S&P 500, the Dow Jones or DJIA, and the Nasdaq. Common investments come in forms of stock, bonds, index funds, also mutual funds and ETFs. But we also have other investment forms like REITs, which means real estate, investment trusts specifically, but you can think of it as real estate. Commodities, that could be gold, and oil is another common type of commodity. There's the Forex or foreign exchange, which is essentially trading money, different currencies between different countries. And then cryptocurrency, that most people might be familiar with Bitcoin. And number three, we typically have access to retirement accounts like the 401k, TSP, or 457B, depending on our employment. There's also IRA and education accounts like 529 plans. And we can also open up a non-retirement account called an individual cash account. So retirement account has two versions. Traditional is funded by pre-tax money, and Roth is funded by after-tax money from our paychecks. So we can have multiple accounts if we wish, like a traditional 401k, Roth IRA, and individual cash accounts. So I'm just pointing out again, they are not mutually exclusive. All right, now we'll move on to the Husky game, and this game will be Seek. So it'll be 5 questions, multiple choice in the form of A, B, C, D, and E. 3 answers will be correct, 2 are incorrect. Correct answers are plus 1 point, incorrect are minus 1 point. There'll be a dollar sign available to choose if a Husky finds it, and that will be plus 1 point. And I'm also using these plush toys, a bull and a bear. So the bull is plus 1 point and the bear is minus 1 point. So to win the game, after 5 rounds, the game is over. The highest points is announced the bull. That'll be the winner. Second highest points is the bear. That'll be almost the winner. And then third place, unfortunately, is the fool, that they participated. They tried their best. All right, on to the games. And looks like bro is going for the bear. Looks like he touched. All right, seek. Seek. Someone must have already got A. Seek, little cheek. Well, E, C. All right, we have 2 more answers left. You guys ready? Come on, Cheek, go get more. You're not even in the picture, Cheek. Come on, go seek. Seek. I'll give it another minute and then we'll stalemate this up. D. All right, bro. One more, bro. Oh, all done. All right, we're stopping. It's all complete, Cheek. You got 0. All right. Stopping. Looks like bro is going for a $sign. And B, go get it, Cheek. Come on. Go get it. You're not participating. Okay, go get the other ones. Go get another one. Oh, bro got D. Nice job. You guys interested in anything else? Bull or bear? You interested in any more, Cheek? Go get more. Maybe you're thinking about it. You interested in the bear or the bull? Oh, you touched the bull. I might give you that point. Good job, Cheek. All right, that ends that sequence. Shutting it down. Seek. Seek. Oh, bro got C. Go, bro. Looks like you got B and D. Come on, bro. And the $sign. Come on. And E. Bart got A. Come on, chick. Can you do one participation? Come on. Can you choose the bull or the bear? Come on. Can you touch the bear? Oh, almost. All right, is everyone done? All right, I guess we're calling that good. All right. Seek answers, bro. Well, Cheek got B. Good job, Cheek. Bro, nice job. You got the bull. Uh-oh. You also got a treat on C. I think Fart knocked over the bear. It's kind of a double. Everyone got a double whammy almost. A shared whammy. All right, one more $sign for the fart. And D for the fart. All right, I think everyone got at least one treat and touched the bull and the bear. All right, we'll call it good. Go find the answers. Looks like bro got B. Looks like fart took an E. I can't really tell. Yep, someone knocked over the bowl. You got the treats, bro? We got A. Did everyone get the treats already? That was quick. I have to use instant replay. All right, somebody touched the bowl and the bear and all that, but I missed it. So we will stop it right now. We are done.